Julian Callow, Chief European Economist at Barclays Capital, joins me now. Mr. Callow, thank you very much for being with us on The Pulse this morning. It's quite interesting, isn't it, to see how the UK still manages to have a higher CPI number. What is that about? Why is there such a difference between Europe and the US on one hand and the UK on the other?
I think it's probably largely down to the impact of import price changes. Although sterling has been relatively stable in recent months, it of course did have a very large depreciation. So if you, for example, compare the level of import prices excluding energy now with where it was at the start of 2007, in the case of the UK, this has gone up by about 22% this series. And the UK is, of course, quite an open economy as well. Whereas for the United States, over the same period, using a similar index for import prices ex energy, the rise has been only about 5%, and for the Eurozone, only around 3% so far. So there's been a much bigger impulse coming from a big rise in import prices. And although that is now a little bit historic, I think the consequences of that are still coming through. And then the next issue is really that the UK government is obviously very keen to lower the budget deficit in a quick way. And that does mean using indirect taxes and other administrative price changes. And that, of course, is also contributing to UK core inflation and keeping the headline inflation rate higher.
Do you think it's something that the UK should be concerned about, this level of inflation? I don't want you to preempt what Mervyn will say in his letter a little bit later on this morning, but we are being told quite regularly by economists that it's something we could almost discount.
Yes, well, it is a little on the high side, perhaps, the inflation readings, but I think when we allow for the fact that there have been quite a lot of government measures that have been influencing that, and when, after all, people perhaps in the United States and Europe are getting more concerned about deflation risks right now, perhaps it's the better side a little bit to be in the current situation. Where it could be a problem, though, is if actually, contrary to the view of the consensus, we do see at the global level quite a significant rebound in the economy and in commodity prices, well then the UK would be in a much more difficult situation, because the inflation expectations measures would doubtless be pushing up significantly higher for the UK, and the Bank of England would be in more of a dilemma, I think.
Now, if it looks like the indicators show that the UK may be slowing, if we look across to Europe at the situation there, we're seeing this increasing gap between what's happening in Germany and what's happening almost everywhere else, including in France. Is that going to be an issue going forward, or do you think we've seen the best of the German growth as China begins to slow?
I think, a lot of people are asking this question. They're very interested in these differentials in Europe. I have to say that for me, I think it's a good thing that Germany is performing well here, because Germany is really the anchor, both economically and politically, and for the financial system in the Eurozone as a whole. Put it another way, if Germany was actually looking miserable in terms of its economic performance and prospects, that would actually be really quite negative news for the rest of the Euro area, and people would really ask if it was going to hold together. At least Germany's doing well. That is boosting German tax receipts, leading to lower than expected deficit outcomes for Germany, and in turn that gives Germany, both politically and economically, I think the requisite level of influence in order to be able to provide a support mechanism, to provide the basis for a support mechanism for the Eurozone as a whole. As well, German imports from the rest of the Euro area are actually picking up, not a lot, and more from Northern Europe than from Southern, but that process is starting to work.
OK, Julian Callow from Barclays Capital, thank you very much for joining us.